In today's video, we are going to talk about 3 ETFs that you can buy and hold for a really long time, like 20 or 30 years. These ETFs are great because they let you invest in a well-diversified portfolio of stocks without costing you a lot of money. They track indexes that often give better returns than most mutual funds managed by professionals. We'll break down what these ETFs actually invest in, how much returns they have made in the past, how much it costs to own them, and how much dividends they pay. If you are new to investing, think of an ETF like a basket of investments. It could have stocks, bonds, or even commodities like gold. ETFs trade on the stock market just like regular stocks, and it might follow an index like the S&P 500, which is made up of 500 largest companies listed on the US stock exchange. My name is Kanak and welcome back to my channel. Your support is what keeps this channel running, and if you find this video helpful, then show your support by liking and subscribing to the channel. Alright, the first ETF that you might want to consider for the long term is the Vanguard S&P 500 ETF, with ticker symbol VOO. This ETF basically follows the S&P 500 index. The S&P 500 represents 500 largest companies on the US stock market. So when you put your money into VOO, you are investing in those top 500 companies. This is a market capitalization weighted index, which means bigger the company, the more weight it carries in the index. In fact, the top 10 companies together make up about 30% of the whole index. Now, S&P 500 rebalances every 3 months, which means the index adjusts every 3 months based on how much the company is worth at that time. Now let us talk about the returns you can make from VOO. If you look at the numbers, over the past 10 years, VOO has given about 12.5% in returns. So if you had invested $10,000 in VOO back in 2014, by 2024, it would have grown to roughly $32,000. But if you stretch the timeline to over 50 years, then S&P 500 has been giving about 10.5% in compounded returns if you reinvested the dividends in the index. Now here's an interesting fact. Over 20 years or more, a whopping 95% of mutual funds managed by professional investors fail to beat this index. So if you stick with VOO for 20 years or longer, chances are you'll do better than most of the big short fund managers. Now let us talk about cost. How much it costs to own a fund can really affect how much money you make in the long run. Luckily, VOO is super low cost. It has what's called an expense ratio of only 0.03%. That means for every $10,000 that you invest, you would only be paying $3 annually to Vanguard. Now compare that to mutual funds. They can hit you with the fees as high as 1% or even more for managing your money. Over a really long time, like 20 or 30 years, those fees can add up to a really big amount. Alright, let's dive into dividend yield. As of now, the dividend yield for VOO is around 1.39%. That means for every $10,000 that you invest in VOO, you would get about $139 back in dividends. Over the past 20 years or so, the dividend yield for S&P 500 has usually been between 1 and 2%. So you can expect to receive anywhere between 1 and 2% in dividends from your investments in VOO. The S&P 500 index represents only the top 500 largest companies on the US stock exchange, but it does not include mid-size and small-size companies. So there is another ETF called Vanguard Total Stock Market ETF with ticker symbol VTI that includes all sizes of companies, large cap, mid cap, and small cap. VTI invests in around 3,750 different companies covering small, medium, and large ones. So when you invest in VTI, you're basically investing in all the companies listed on the US stock market. Even though VTI covers way more companies, the top 500 companies in the S&P 500 still make up a big part of it, about 80%. This is because VTI is also a market cap weighted index, which means larger companies have a larger share in the index. The top 10 companies in VTI are similar to those in the S&P 500, but they make up marginally smaller portion of the total index at about 26%. Because VTI is mostly made up of the same big companies as of the S&P 500, its performance is similar, although a bit lower. Over the past 10 years from 2014 to 2024, VTI's returns has been around 12.13%, slightly less than that of S&P 500. So if you invested $10,000 in 2014, it would have grown to about $31,000 by 2024. VTI is also cheap to invest in, with an annual fee of only 0.03%. That means for every $10,000 that you invest, you would only be paying $3 in annual fee to Vanguard. It also pays dividends similar to VOO at around 1.38% annually. So for every $10,000 that you invest, you would get about $138 in dividend each year. In short, VTI lets you invest in the whole US stock market, including companies of all sizes, with slightly lower return compared to the S&P 500, but at the same cost and with similar dividends. The ETFs WU and VTI represent only stocks listed on the US stock exchange. They don't include stocks from major international markets like Europe, Japan, China, and so on. But there's an ETF called Vanguard Total World Stock ETF or VT, which has about 10,000 stocks from both US and international markets. VT covers stocks from developed as well as emerging markets worldwide. Now let us talk about the geographical distribution. About 63% of VT is from North America, 15% from Europe, and 10% from emerging markets. And the US makes up about 61% of VT, followed by Japan, UK, Canada, and China. Looking at the top 10 companies in VT, we see that they are the same as that in the S&P 500, although with lower share of the total index. In terms of performance over the last 10 years, VT returned about 8.57%, while the S&P 500 returned 12.78%. And this reflects the fact that the US stock market performed better than the international stock market. Now, if we look at the returns over the last 50 years, the total world stock market returned about 8.5%, while the S&P 500 returned about 10.5%. So historically, the US stock market has done better than the total world stock market. But past performance does not guarantee future results, and it is hard to predict how the global economies and stock market will shape up in the next 2 to 3 decades. But if you're looking for international diversification, then VT is the ETF that offers you the exposure to the global stock market at very low cost. The expense ratio for VT is only 0.07%, which means for every $10,000 of your investment, you would only be paying $7 in annual fee to Vanguard. The dividend yield of VT is about 2.04%, slightly higher than WU. So for every $10,000 invested in VT, you can expect to receive about $200 in annual dividends. So even though VT has historically not outperformed the S&P 500, it allows you to invest in all the stocks across the globe, both emerging as well as developed market at very low cost. That's all for this video. Let me know your thoughts in the comment section below. Thank you.